Hey guys, in today's video we'll walk through one business transaction from the beginning, which when the transaction takes place, and take it through the financial statements. So we'll go through the journal entry that comes from this transaction and how that flows into the general ledger, and from there to the trial balance all the way through to the financial statements, so that if you are someone who is new to accounting, you would get to see how the process works, how the transaction shows up on the financial statements. And if you're someone who's already an accountant, this would just reaffirm everything you already know. So on the channel before, you've seen we have a good accountant and a clueless accountant that we use to explain these things. Today is going to be explained by our good accountant. So we're going to go ahead and bring him in to show us how this works. And before that, I want to give a big thank you to everybody who wrote a review for my Controller Academy. We are now at about 67 reviews, and we have an average almost 5 stars for my course. So thank you so much for that. All right, so let's see. So I'm going to take you guys through this transaction here. What we have is a purchase of finished good inventory of 1,000 treadmills. So this is a company that buys treadmills as inventory and sells it. 1,000 treadmills for $1 million on March 29th, 2024. So the first step in the process is going to be journal entry. So in this case here, if you're using an accounting software, you most likely are not going to be recording a journal entry. You are going to be recording a goods receipt transaction. This goods receipt transaction is going to book on the back end the entry in the ledger. But it's not going to be a manual entry. You'll be doing a manual entry if you're using Excel for bookkeeping. But in this case, we're using an accounting software that's going to book a goods receipt, and that's going to debit inventory for $1 million and credit accounts payable for $1 million. And the accounts payable is going to be settled within 30 days because that's our terms with the vendor, and that's going to clear cash. It's going to be debit to accounts payable and credit to cash. Okay, so that's the first step in the process, which is the journal entry. The second is going to be the general ledger. So once a goods receipt entry is made to debit inventory, that's going to record it in the general ledger. The general ledger is just a listing of all of the activity in the account. So when we set up the accounts, we have a chart of accounts. We have finished good inventory. You might have multiple finished good inventory accounts. So in this case, we have 2. We have one for treadmills, and we have one for TVs. If we look here at the trial balance, there are 2. There's treadmills and TVs. These are the 2 finished good inventory that we are buying. So at the general ledger, you'll see that there is an opening balance at the beginning of each month. So in this March 1st opening balance, it's $2 million. And then each activity in the account, so a sale of 300 units would credit the account for 300,000. That reduces the balance in that general ledger account. We'll see here our transaction is going to be a purchase of 1,000 units for $1 million, and that's going to be increasing our balance, resulting in an ending balance in that account of $1.7 million. Okay, this is the second stop in our transaction flow, is the general ledger. From general ledger, the next step is going to be a trial balance. So the trial balance, what it is just showing all of the ending balances of the balance sheet accounts. So all of the balance sheet accounts, which is assets, liabilities, equity, showing the ending balance of that account. While for expenses and revenue, the trial balance would be showing the amount of the activity in the period. So this is a monthly trial balance. So this is showing the trial balance at the end of March 31, 2024. For balance sheet accounts, it's showing the ending balances. For income statement accounts, which is revenues and expenses, it's showing the activity for March of 2024. Okay, so the trial balance is just showing all of the balances in each of the general ledger accounts. And then it's a trial balance because you are trying to say, are the debits are going to equal the credits or not? And if you're using an accounting software, it's always going to be the case that your total debits is going to be equal to your total credits. Because the accounting software in general won't allow you to record a transaction unless you have a debit that's equal to the credit, right? But that's the trial balance. The trial balance exists in 2 states, unadjusted and then adjusted trial balance. The unadjusted trial balance is going to show the balances in the account after the activity in the month without adding in month-end adjusting entries. And then once you record adjusting entries, such as spoilage, obsolescence, so let's say you have inventory that is obsolete or expired or damaged, you write it off, and that's an adjusting entry, and then you would have an adjusted trial balance. For our example here, we'll assume that this is an adjusted trial balance. Now, from the trial balance, our next step is going to be preparing the various financial statements. For the first step here, we have income statement, and I have a video on how to turn a trial balance into an income statement and a balance sheet. Take a look at that. I'm going to link it up here and down in the description. So for the income statement, this particular transaction is an inventory purchase. It's not going to impact our income statement directly. So when you buy inventory, it's not going to be cost on the income statement. It's going to turn into cost, which is cost of goods sold, once you start selling the inventory. So in this case here, it doesn't impact the income statement directly, but it's going to land in cost of goods sold at some point when you start selling this inventory. Now, the next step is going to be the balance sheet. So the balance sheet is going to be a summation of the ending balances of the similar accounts on the trial balance. So for example, on the trial balance, we have two accounts that are finished goods accounts. So if you look here, we have finished good inventory and finished good TVs. These two accounts will get added together on the balance sheet as finished goods inventory. So if you look in the balance sheet here, you'll have an inventory line item that adds up the two balances together in the balance sheet. So this is where our purchase is going to show up on the balance sheet. Now, from the balance sheet, we can prepare, we take the net income from the income statement and then the balance sheet accounts and create a statement of cash flow. Now, for statement of cash flow, this shows the changes in cash. And this is an indirect method of statement of cash flow. I made a whole video on how to prepare the statement of cash flow. I'll leave a link to it up here and down in the description. You can watch it after this video. But pretty much what it does is it takes the net income or loss from the period and then adds in non-cash items. So for example, here we have depreciation. Depreciation is non-cash, right? It's a non-cash expense. So we add it back. And then we have changes in the various balance sheet accounts, like changes in accounts receivable. Accounts receivable, in this case, for example, as you can see, it went down. So that's going to be increasing cash, right? Because accounts receivable going down means that you collected more cash, right? For inventory, if you can see here, our inventory went down from February to March. And that's going to signal here in the statement of cash flow an increase in cash, because as your inventory, if you think about it, as your inventory is sold, inventory balance goes down. It means that you brought in more cash. Okay, so that's how it's going to show up in the statement of cash flows. So as you can see, just to recap, a transaction, purchase of finished good inventory, that's going to be a goods receipt entry in your system. That's going to debit inventory, and it's going to show up in the ledger as an increase, as a debit. That increases the ending balance of inventory, finished good inventory. That's then going to get translated to the trial balance. 1.7 million is going to show up here as an ending balance for a trial balance. And then when you sum it up in the balance sheet, you're going to be adding two accounts together to show the inventory at month end. And the way that it's going to show up in the statement of cash flow, it's going to be a change or inventory account that's going to show cash coming in from inventory. So that's been the flow of the transaction. I hope that you enjoyed the video. I'm going to leave this file in the description so you can download it and kind of see visually what I'm talking about here. If you like the video, give it a big thumbs up. Share it with someone who will enjoy it or learn from it. And I'll see you in the next video.